Hi there, I'm Matthew Lester from the Rhodes Business School in Grahamstown. This is a brief summary of the VAT system in South Africa. Now, people get awfully upset about it, but down here at Rhodes University, well, we've got some simple solutions to help you be less frightened of the South African VAT system. And the first thing one has to look at with VAT is what's it all about. VAT is about 28% of total tax collections in South Africa. Without VAT, the whole of South Africa would collapse. We have to have it, and we have to have it strictly enforced. If one looks at this, what you have got to realize as an entrepreneur is that you are collecting VAT on behalf of the state. They may not be paying you to collect VAT, but if you don't collect VAT, you're liable for a criminal charge of theft. So we better take it very seriously. So we start off and say, when does one have to register for VAT? So the basic rule goes like this. You register for VAT when you have sales from goods or fees amounting to more than 1 million rand in a 12-month period. Now that is absolute. Once you exceed 1 million rands of taxable supplies, goodbye, you are a VAT vendor, and you then have to register for VAT. So, as soon as you know that you have gone over the R1 million mark or are likely to go over the R1 million mark, you have got 21 days to go and register at SARS. No exception. The type of registration that we refer to there is a compulsory registration. If your turnover is below R1 million per annum, and more than 50,000 Rand per annum, you may undertake what's called a voluntary registration. And some businesses like to do that because they like to get their VAT going early on in their business cycle because it reduces the costs of what you are buying. So, a person who is registered is then referred to as a vendor for VAT purposes. They can be individuals, they can register as a partnership or body, private companies, public authorities and municipalities, even associations not for gain, you name it, they are all required to register. Notice that's what's very important in that. You don't have a profit motive. So long as you are selling goods and services, you are responsible for registering as a VAT vendor, even if you're an insolvent estate. So we take that forward and we say all of those people are liable to registration. Registration is not required if it is unlikely that your fees will not exceed R1 million per annum. But remember again when doing that, if you don't register, you can't claim input tax. Your input tax, which we will deal with later, becomes a cost to your business and drives down your profits. So we want to register for VAT, but before you run off and do that, please remember one thing. It's going to cost you a lot of money to run your VAT system. And you're not going to get that back from SARS. That's just your duty as a business. And that cost can sometimes be more than the input tax that you are going to save by registering if you're below 1 million rand. You also don't have to register if your supplies are exempt from VAT. We will look at that under a different section. Then also employees who earn a salary of more than R1 million are not required to register if they are receiving remuneration. Now, remuneration is the amount on which you pay your monthly employees tax. So even if I have a salary of more than $1 million, doesn't matter, I don't have to register for VAT. Registration is not required on hobbies and private and recreational activities or private and occasional transactions. For example, if I sell my house, that might be well more than R1 million, I don't have to register for that one transaction, but there will be transfer duty. So, if sales and salaries are more than 50,000 Rand, you can go for the voluntary registration route, but always be careful there, please. It's going to cost you money to run your VAT system. Then you go forward and you fill in the forms, and the commissioner can come back to you and say, we don't want you as a VAT vendor because you haven't got proper books and records, or you haven't got a proper place of residence in South Africa, or you don't have a bank account, or you've previously been convicted of some VAT misdemeanor or felony in the past. They have a discretion to chuck you out, and sometimes they'll even chuck you out if your threshold is not going to exceed the 50,000 Rand minimum threshold in a year. So you have to be able to prove that to get a VAT number. Right. The commissioner may also cancel your registration. They can say, we don't want you as a VAT vendor. And that is where your turnover drops to a level below the minimum requirements. They can also deregister you if your enterprise ceases to make taxable supplies, or it never actually commenced within the 12 months that you said it would. It then comes down to when do you pay your VAT. Now this is where we bring in what's called a tax period. Now you receive VAT from your customers on your billings on a daily basis. Now SARS is not going to wait for a year to get that money back from you. So they have different categories and different tax periods for the different sizes of VAT vendor. So we can get tax periods end at the last day of each calendar month. Most businesses, if their turnover is less than 30 million Rand per annum, only pay VAT over every 2 months. So then we get the 2-month cycles, and they differ. Some get January, March, May, June bi-monthly ends, and others get February, April, June month ends. Why? Well, they're trying to stagger the workload to SARS. And then those who have turnover of more than 30 million Rand per annum, SARS is not going to wait. They want their money every month. That is a category C vendor. They do a monthly VAT return. Of course, we have to have an exception for farmers. They're allowed to put their returns in on a 6-monthly basis. Well, there are very few of those. We're just noting it for the record. And then there's a 4-month potential VAT period if your turnover is less than 1.5 million Rand and you are an entrepreneur. So they go March, June, etc. And then July to October, and then November to February. You can go on that route. It's not really advisable because you lose sight of your VAT liability, and suddenly at the end of 4 months, you have a massive liability to SARS. Then we talk about the time of supply. That's an important term. That is, when is a transaction deemed to have happened for VAT purposes? Now, most vendors use what's called the invoice basis. The moment that you raise an invoice, you have the liability to pay over to SARS at the end of that tax period, whether you've been paid by your customer or not. There are some who are allowed to use the payments basis, but that is a concession that is normally afforded to small businesses who have notified SARS and have a turnover of less than 1.5 million Rand per annum. The payments basis is there to help small business. So there's a maximum threshold, and they say if your turnover does not exceed 2.5 million Rand per annum, you may elect to pay on the payments basis. And that can help small businesses. But remember, if you adopt the payments basis for your sales, you also have to use the payments basis for your inputs. So that's the start of the VAT system. The next part in the series looks at what is a taxable supply. Hi there, I'm Matthew Lester from the Rhodes Business School. We're talking about VAT. And in this particular lecture, what's it about? A taxable supply. And when people see words like this, they run away. They don't like it. And so we've got to go in there and carefully define what they are on about. A taxable supply is basically a VAT leviable transaction. A person is carrying on an enterprise if the following requirements are met. The activity is carried on continuously or regularly by a person in the Republic. And in the course of that, you make supplies of goods and services to other people. The consideration is the amount that is made. A supply then is widely defined in the Act including all forms of sale, rental agreement, installment sale agreement, you name it. They cast the net as wide as they can so that they can catch everybody. It includes voluntary and compulsory transactions, irrespective of sometimes whether the supply is actually affected, and even includes derivatives. Basically, you can take it. If you've concluded a transaction in a business, that is a supply for VAT purposes. Now, this is where it gets a bit more awkward. We get into different types of supplies. We get standard supplies. Now, a standard supply is a normal transaction that is subject to VAT at the normal rate of 14%. That covers most transactions. Then we have zero-rated supplies. Now, zero-rated supplies are VAT leviable supplies where the VAT is levied at 0%. Why don't they just call that an exempt supply? There's an important distinction here. If you've made a zero-rated supply, that means that you can reclaim the input tax on the cost of all the things that you've bought to make that supply. If you've made an exempt supply, which we're going to see just now, the VAT is never reclaimable. Zero-rated supplies are there mainly to help two groups of individuals. First are exports. We don't want to discourage exports by putting South African VAT on our exports. The second is a means of providing relief to the poor. So your zero-rated supplies are at 0%, but they must be supported by documentation. Obviously, the Commissioner wants to see all of that to prove that it is a zero-rated supply. They include the basic foodstuffs. So South Africa gives concessions of about 20 billion rand a year to the poor, where there is no VAT on, for example, bread and basic foodstuff. There's no VAT on fuel. Why? Because there's already a fuel levy of far greater than the VAT rate. When you sell a business lock, stock and barrel, that can be zero-rated. Some farming goods are zero-rated. Goods temporarily imported into South Africa for repairs are zero-rated. And then the big one, exports. Exports of goods and services are not subject to VAT. Neither is international transport. That is transport from a destination in South Africa to a destination outside South Africa. And then when services are physically rendered outside of South Africa. And there are some obscure zero ratings for when we provide services to non-residents, but we don't see those very often. Then municipal property rates and taxes, that's already a form of tax, so that's zero-rated. The value of supply then comes in. How much do you put on the invoice? Scrap that last sentence. Whatever you put on the invoice is the value of your supply that is subject to VAT. That is the consideration, and the total consideration is then subjected to VAT. We now move on to exempt supplies. Exempt supplies are where you don't charge VAT, but you're not able to reclaim input tax on the cost of the goods and services that you have to buy in to give your service. So it is a form of concession, and it does give some relief, but not total relief. So a person who has exempt supplies is not required and cannot register as a VAT vendor because they cannot charge VAT. Now, this has broad categories. Financial services are not considered to add value. If you're charging interest from one person to another person, there's no overall increase in gross domestic product. So it's exempt. And along with that goes the services of provident pension funds and retirement annuity funds. Donated goods are exempt. Residential accommodation. If the period of occupation is less than 45 days, residential accommodation is exempt from VAT. Rail transport and taxi transport within South Africa is exempt from VAT. So a taxi owner does not charge VAT, but then you can't reclaim the VAT expended in buying the taxi. Transport by road and rail is exempt if it is within two places within South Africa. If the transport is across the borders, then it is zero-rated. then fare-paying passengers are exempt. Also, international transportation can also be exempt. There are some funny ones here, for example, game viewing vehicles. There's been a lot of debate around that. Don't worry about it too much unless you're in the game industry. The transportation of goods within South Africa does not get an exemption. That is subject to VAT at the standard rate. However, when the goods are a person who's traveling, when that's their baggage, that is not subject to VAT. Transportation of passengers by air and sea is a standard rated transaction. So look at this. If I travel from Johannesburg to Port Elizabeth by taxi, no VAT. If I go on the airplane, I pay VAT. If I go by bus, I don't pay VAT. Where international transport is supplied, that is a zero-rated transaction. Then the next big category is educational services. Schools and universities are not subject to VAT. So we say, oh great, they're outside the VAT system. No, they're not, because they get an exemption. So all the costs of the schools and universities that they incur are subject to VAT when they buy them in, but they're not able to charge a VAT charge on their fees. So those VAT costs of those institutions becomes a cost to the business. So that's the basics of taxable supplies. Let's move on in the next series to look at VAT and input tax. Hi, I'm Matthew Lester from the Rhodes Business School. Today we are talking about input tax in the VAT system. And it works like this. Input tax is the VAT that has been charged on the supplies acquired by a business. They have to be able to reclaim that. So long as the goods are acquired for purposes of making further supplies to somebody else and you're a registered VAT vendor, then you are able to claim input tax. It is important that it can only be deducted insofar as you have used the goods and services that you have acquired in the course of making further taxable supplies to your customers. Input tax may not be reclaimed if it is acquired for purposes of making exempt or other non-taxable supplies. The denial of the input tax credit can happen in certain instances. One of the main categories is entertainment. Membership of clubs, etc. Obviously, they don't want you to reclaim that. The acquisition of a motor car by a vendor is also not reclaimable. And then goods and services supplied by a medical aid scheme also cannot be reclaimed. Now, what is the definition of entertainment for VAT purposes? They go like this. It's all food and other ingredients purchased in order to provide meals to staff and clients. So, when you work for an employer and you get some lousy coffee, that might not be entertainment as you see it. However, it falls within the definition of entertainment. Business lunches, golf days, corporate entertainment, movies, theatres, restaurants, all out. You can't reclaim them. Goods and services that you acquire into a business for purposes of providing meals to your employees also are categorized as entertainment, and the input credit can never be claimed. Beverages, meals, entertainment, shows, etc., etc. Anything with regard to food and booze can't be reclaimed. And then some of the entertainment assets of a business, where they have a rugby box, a house at the coast, private yachts and aircraft, can't reclaim that either. And then they brought in, obviously, a policeman to define what is a motor vehicle for VAT purposes. The VAT on motor vehicles cannot be reclaimed. So the term motor car is defined in the VAT Act. It says it must have 3 or more wheels, normally used on public roads, and constructed or adapted for the carriage of passengers. Then that will be a motor vehicle, and you will not be able to get the VAT back on it. So a motor vehicle includes double cab buckies, a sedan car, station wagons, minibuses, sport utility vehicles, and more. But it excludes certain other things. Such as transportation trucks, because we're moving goods then and not passengers. Single cab buckies, even if they're sports buckies. If it's only got 2 seats in the front, you can reclaim the VAT. Motorbikes, why? They've only got 2 wheels. Caravans, ambulances, game viewing vehicles and hearses, and then the list carries on with all sorts of different vehicles that fall outside of the VAT definition where the VAT can be reclaimed. For example, if we've got a company bus, 44-seater, we can claim that if it's used to transport our staff, so long as we're not charging for it. However, if it has less than 16 seats, i.e. a minibus, then we can't reclaim it. Then special equipment, we can reclaim the VAT on that, such as bulldozers, graders, heisters, and all the rest of it. There is a special concession for hearses and game viewing vehicles. They can now be reclaimed because the services ancillary thereto are now subject to VAT. So, there is your basic outline of the VAT output and input system. The next thing comes, how do we account for it? And that we'll do in a separate lecture. Hi there, I'm Matthew Lester from the Rhodes Business School. This is a lecture about tax invoices. They are, if you want, the driver of the VAT system in South Africa. You've got people charging VAT and claiming VAT, and it has to be underpinned by a documentary system. Now, please get this right. If you don't get your tax invoices right with SARS, you are going to have a hell of a hard time in the course of inspections. So let's have a look at it. On tax invoices, they say this is the driver of the VAT system. Without a proper tax invoice, remember the recipient of the tax invoice is not entitled to reclaim input tax. So then the VAT becomes a cost to their business, and we don't want that. Now, we don't want to be silly about it. Vendors are not obliged to have petty cash vouchers with tax invoices for transactions of less than 50 Rand. Many of them actually just go ahead and they do that anyway. They just produce them. These are small expenses, and obviously SARS doesn't want to get cluttered up in the process. These are small expenses, and obviously SARS does not want to get cluttered up in the process. Now, we talk about a full tax invoice in terms of Section 20 of the VAT Act. What's got to be on the invoice? First of all, it's got to be called a tax invoice. Not a pro forma invoice, not an invoice, only a tax invoice will do. Then the name of the supplier plus his address plus his VAT number has to be on the tax invoices. And also the name and address and VAT registration number of the purchaser, plus the serial number and the date of issue, plus a full and proper description of everything that has been supplied, plus quantities, plus the price excluding VAT, the VAT, and the price inclusive of VAT. If any of those items are missing from a full tax invoice, it is disqualified for the recipient to reclaim that VAT as input tax. They'll have to start again. So there is an example of a tax invoice with all the different requirements that are on it. What we've got to do in any system is devise an invoicing system that complies with Section 20 of the VAT Act to make sure that all of those requirements are properly met. Now, there's another example. Again, all of the items in Section 20 appearing on the tax invoice. Now, you can have an abridged tax invoice in terms of Section 25 of the VAT Act. And this has its requirements on it which seem to be similar for the supplier. The difference comes in for the purchaser. The purchaser's name and VAT number and all of that sort of stuff does not have to be there. So there is an example of an abridged tax invoice. However, let's be careful here. Do you really want to have a system that has both full tax invoices and abridged tax invoices? Not really. You might as well, if you have a system, have a full tax invoice-based system so that you can generate the tax invoices that your customers require. Now, a vendor must issue a tax invoice to a recipient within 21 days of making a supply. That's the law. you can actually have a criminal offense for failure to actually deliver a tax invoice. If the consideration in money for supply is 50 Rand or less, well then a tax invoice is not required. That's a petty cash disbursement, but most of the time we get those invoices anyway. A tax invoice has to be in South African currency, except when we are dealing with zero-rated supplies to foreign countries. Then the transaction is zero-rated and we can put it in foreign currency. Those are exceptional cases. A vendor who fails to detect input tax in respect of a particular transaction can then go and claim it back later. So what happens here is a vendor has a tax invoice which is not compliant with Section 20 of the VAT Act. They don't then delay submitting their claim, or then they're not disqualified for making a claim. What they've got to do is go back to the supplier and insist on a full tax invoice, and they can claim it in a subsequent period. Lost or misplaced tax invoices, well, then we have to go back to the supplier. We can't just take the law into our own hands and say, oh, well, we paid that VAT, here's a copy of it, or whatever. We have to go back to the supplier and say, please issue us with a new tax invoice. So the supplier will then come along and they can't issue the same tax invoice again. We only can have one tax invoice per transaction. They've got to issue a copy of the tax invoice, clearly marked copy, so that SARS can check that on their inspections. Facsimiles of tax invoices are not acceptable, although arrangements can be made to send PDFs. Then we have a system for second-hand goods. Now this is when a VAT-registered vendor acquires something from a non-VAT vendor. In such instances, obviously VAT would not be charged, but that doesn't prevent you from reclaiming the deemed VAT that is applicable to those goods. But we have to keep all comprehensive details of the person who supplied it. Their identity number, date of acquisition, quantity of goods, description of goods, consideration of supply, proof of payment, and a declaration from the supplier saying that they are not a VAT vendor. The vendor must verify the identity number against an ID book or passport and retain a copy so that we can prove the identity of the person that we have acquired those goods from. Be very careful when you go into the realm of second-hand goods and services in VAT. What we have to say is we have to keep absolute documentation, because we know that if there is going to be an inspection from SARS, they're going to go straight for the second-hand goods to see that you have kept proper books and records. Right, in the next session after tax invoices, we're going to look at the final lecture in this series, which is the completion of the VAT return. Hi, I'm Matthew Lester from the Rhodes Business School. Now we're going to look at what have we got to have in a VAT return. Now, it is absolutely essential that once you've registered for VAT, you design a system so that you can get the right figures to complete your VAT return. And the best way of explaining this is to look at the requirements of the VAT return. So there is a VAT return as downloaded off e-filing. It looks pretty frightening, but actually it isn't. What have we got to do with this thing? I've blown it up a little bit there on the screen, and I'm going to disappear off screen here for a moment while I explain it. The first and most important thing in a VAT return is to get your total value of your taxable supplies, including VAT, goes in the first column. That is then multiplied by 14 over 114 to bring it back to the VAT exclusive amount. That is then multiplied by 14 over 114 to get to the VAT exclusive amount. That is generally, for most vendors, your VAT output tax. Then we have different categories for zero-rated transactions, exemption. We then have a separate category for where we have sold capital goods, the fixed assets of our business. Those transactions don't happen every month, but because we have claimed input tax on them, we are required to pay output tax when we sell them. That's also multiplied by 14 over 114. Then we have zero-rated supplies. We have to put them on the VAT return, even though they are not liable to VAT. And then we have exempt transactions, which are also put on the VAT return, even though they do not create any VAT liability. We then have some other little adjustments and things which don't happen all the time. That can be, for example, where you discontinue the use of your business and the final transaction is to declare VAT on anything that's left. That doesn't often happen. That is then all added up to give you your output tax liability. From that, you can deduct the VAT that you have incurred in the course of running your business. So first of all, we have to be able to add up all the VAT that we have dispersed from all the transactions where we have acquired stock and services in the course of running our business on a daily basis. So we have to design an accounting system which adds up and cross-references all tax invoices, making up that globular figure in the VAT return. That's not easy, but the first thing that SARS is going to ask for when they come for an inspection is to see the tax invoices. So this is where we've got to be clever and have a pre-listing of all the tax invoices, and they must all be filed, the originals thereof, so that SARS can look at them. The next category is all the capital goods that you've acquired in the course of your business. They also have to be added in and separately reflected. There are other adjustments as well in a VAT return, such as own use, where we haven't used all our taxable supplies in the course of running our business. That doesn't often happen. Then, output tax is added up and input tax is deducted. The net amount is your VAT liability that you owe to SARS. That's what's got to be paid by the 25th day of the calendar month following the end of your tax period. If you land up in a refund position, you may then claim a refund from SARS. But please, I can tell you now, you are going to get an inspection, and you better have all your documentation handy before the SARS officials arrive. So that's how you complete your VAT return in basic form. When you're setting up a new little business, it's always a good idea to get some advice from somebody who's competent in VAT to design a nice, efficient system to help you with the completion of your VAT return. I'm Matthew Lester at the Rhodes Business School. Thank you for your attention.